Welcome back to Smart Stock Sam. I'm Sam, and this is the video where we give you the warning nobody else is giving you and the real truth behind that explosive DVLT surge. Because here's the thing, our last tactical call on this exact stock nailed the entry almost to the penny, and the follow-through was violent. Today, we're pulling back the curtain on all of it. We'll walk through the strange, split personality of this company, the corporate headlines lighting a fire under the share price, the ugly financial reality hiding underneath, who actually owns this stock and who just quietly walked away, the dilution machine grinding away at your ownership stake, the short interest numbers that look almost too good to be true, the hidden dark pool activity most traders never even think to check, what the charts are screaming right now, and finally, a full tactical trade blueprint for early July, entries, targets, and hard stop losses included. Stick around because by the end of this video, you'll understand exactly why this stock could either mint fast profits for disciplined traders or wreck the account of anyone who treats it like a long-term investment. And stay for the very last section, because that hidden dark pool number might be the single most important thing you learn about this stock today. Let's get into it. Let's start with what we call the DVLT paradox, because this stock is genuinely fighting itself. On one side, you've got the macro reality, and it is rough. This is a fundamentally distressed piece of equity carrying real, immediate existential risk. If you're the type of investor who reads balance sheets before bed, this company reads like a horror story. But flip to the other side, the micro opportunity, and it's a completely different animal. This stock has been coiled like a spring, with short interest compressed so tightly that it's created near-perfect conditions for forced algorithmic buying. Translation? Terrible fundamentals, but a genuinely lucrative mechanical setup for early July. Right now, the market isn't pricing this stock on where the company will be in 3 years. It's pricing the next few days of a squeeze. And that split is exactly why this ticker has become must-watch trading theater. Could a stock this fundamentally broken really keep climbing for weeks on end? History says probably not, but for the next few sessions, probably isn't the question that matters. Now, if that sounds like empty hype, let's rewind to prove it isn't. In our previous forecast on this exact name, we called this move before it happened. We flagged an entry trigger at 33.7 cents. The precise moment price broke above its 20-day moving average and cleared its first resistance level. What followed wasn't a gentle drift higher. It was full momentum ignition. Algorithmic buying collided with short seller panic, and the stock tore through every target we laid out. It blew past our first target of 34.6 cents, sliced clean through the 50-day moving average at 36.9 cents, and smashed the 40-cent psychological ceiling like it wasn't even there. At the peak of that vertical spike, DVLT touched an intraday high of 44.30 cents. That wasn't luck. That was the predictable, mechanical result of trapped short sellers hitting the eject button all at once. So when we say pay attention to what comes next, understand we've already shown you we can read this tape. And the volume behind that move deserves its own spotlight. We just watched roughly 90 million shares change hands, which is about 2.2 times the 65-day average. You simply do not see volume like that without serious algorithmic and institutional money getting involved. Price swung from a low near 25 cents all the way to that 44-cent high, good for a 21% jump across 2 trading sessions. And this is the part that actually matters for what happens next. It wasn't a one-day flash. With a genuinely strong macro backdrop for tech and artificial intelligence names, the stock has settled into a consolidation zone between 40 and 42 cents. Buyers are absorbing every bit of new supply thrown at them. And critically, price is holding firmly above that prior 36.9 cent target. Could this consolidation be the launchpad for the next leg higher? The setup certainly rhymes with it. So what's actually pulling all this buying pressure in? A wave of genuinely massive corporate headlines. First, Datavault announced a monumental $700 million Phase 1 agreement with Patriot Strategic Metals to build out something called the SMAP platform, a project designed to tokenize strategic minerals. Under that deal, DVLT is allocated up to $62 million for technology integration, plus 25% of net distributable profits. Second, the company is injecting fresh liquidity by liquidating 837 Bitcoin to Silex Holding Company for $50 million, an 8K bound agreement structured as $30 million upfront with $20 million in installments running through 2028. Layer on an aggressive rollout of a 48,000 GPU edge computing fleet, the completed all-stock acquisition of Cybercatch, and even a digital twin project monetizing the legacy of Baseball Hall of Famer Roberto Clemente, and you've got a genuine barrage of headlines built to grab retail attention. Could one of these catalysts alone be enough to send this thing to $1 overnight? It's the kind of question every trader watching this chart is quietly asking themselves. Realistically, no single headline moves a stock this far on its own, but stack 5 of them inside a couple of weeks, and you start to understand exactly why volume has gone parabolic. But none of that matters if we ignore the risk sitting directly underneath it, and it is severe. In the first quarter of 2026, Datavault posted a net loss of $53,130,000 against just $3,410,000 in actual revenue. On top of that, the stock is staring down a hard NASDAQ compliance deadline of August 24, 2026. Miss that $1 minimum bid requirement, and delisting becomes a very real possibility. Then there's the legal overhang. Pomerantz LLP is actively investigating the company for potential securities fraud, following a scathing short seller report from Wolfpack Research that alleges much of this is a promotional story built on unverifiable tokenization revenue. And here's the number that should stop you in your tracks. The company's independent auditor, BPMLLP, abruptly resigned on June 15th. Without an auditor in place, there is currently no independent way to verify any of those big revenue claims. Right now, you're simply taking management's word for it. Could that auditor gap get resolved quickly and quietly with a new firm stepping in and confirming everything checks out? It's possible, but until it actually happens, every headline number in this video deserves a healthy dose of skepticism. With that much uncertainty, who's actually holding the stock? And are they staying or heading for the exits? Silex Holding Company remains the dominant shareholder by a wide margin, controlling 213,700,000 shares, more than 37% of the entire company. On the institutional side, roughly 100 owners hold about 46 million shares combined, including Vanguard with 11,800,000 shares and BlackRock with 4,500,000 shares. But notably, prior major holders like Joseph Reda and Gregory Castaldo have fully exited their positions, and retail traders are facing a strange headwind of their own. 7 board directors recently granted themselves 250,000 shares each at an execution price of $0. That creates a strange valuation paradox. Wall Street analysts have actually attached a $3 price target to this stock, implying roughly 10 times upside based on a price-to-sales multiple of 6.9 compared to semiconductor peers. Could this stock genuinely be a 10-bagger from here? On paper, yes, but that number is entirely dependent on an auditor stepping in to verify the books. Speaking of those $0 insider shares, they lead directly into the biggest structural threat facing anyone holding this stock long-term, what we call the dilution engine. This is how value quietly gets pulled out from under retail shareholders. Management has been aggressively using share issuance to fund operations, and every new share printed shrinks the slice of the company you actually own. Flow 1. A $60 million direct offering that issued 109,100,000 shares, priced at a steep 25% discount. Flow 2. To help fund the Cybercatch acquisition, the company simply printed 49,900,000 brand new shares. Flow 3. 2,720,000 warrants were issued to institutional partners, including Maxim Group as compensation. Every one of those issuances suppresses fundamental value a little more, and it's exactly why long-term buy-and-hold investing here is so dangerous, and exactly why traders are leaning on pure mechanical price spikes instead. But here's the twist. It's precisely because the fundamentals are this weak that the trading opportunity is this good. We call this the pressure cooker. Total short interest currently sits at 104,300,000 shares, meaning close to 20% of the entire available float is betting against this stock. The number that really matters, though, is the days to cover ratio, sitting at 3.81 days. In plain terms, if every short seller tried to buy back their shares today, it would take almost 4 full days of average volume just to unwind those positions. And while they wait, they're bleeding cash, with borrow fees sitting at an elevated 10%. That's a brutal daily toll just to stay short. So how does all that pressure actually translate into a violent move higher on the chart? Through what we call the squeeze engine, and it unfolds in 4 stages. Stage 1 is the trap. Those elevated borrow fees slowly drain capital from short sellers sitting on over 100 million borrowed shares. Stage 2 is the catalyst. Sudden, high-profile news, like that $700 million SMAP deal or the Bitcoin liquidation, shifts retail sentiment and sparks an initial volume surge. Stage 3 is ignition. As price pushes through key resistance, over-leveraged institutional shorts start getting margin called. And stage 4 is the one every trader dreams about, mechanical buying. Because days to cover is so elevated, a genuine traffic jam forms at the exits, and trading algorithms are forced to buy back shares at whatever price is available, creating exactly the kind of violent vertical spike we already watched play out. Now here's the piece almost nobody is talking about, the hidden metric that actually changes how you should be thinking about this whole setup. Picture an iceberg. Above the waterline, in the lit market, you see the retail and institutional volume reacting to daily headlines. But below the surface, in the dark pools, is where a huge chunk of the real positioning happens. An eye-opening 59% of all recent short volume, roughly 38 million shares, is being routed through off-exchange dark pools. Institutional bears appear to be quietly suppressing price away from the visible tape. But here's the strategic upside. Because so much of this shorting is happening off-exchange, those hidden positions are unusually exposed. If visible retail volume keeps surging on the lit market, those dark pool shorts could get completely overrun, triggering an even more violent covering event than the one we already saw. Is that the spark that sends this thing toward that dollar target? Nobody knows for certain, but the mechanics are lined up for it, and it's exactly the kind of hidden fuel that most retail traders scrolling past this stock will never even notice. And right now, the technical picture is leaning hard into that story. On the short-term charts, the signals are flashing a strong buy. Yes, the weekly and monthly charts remain a firm sell because of the macro backdrop, but the 5-minute, 15-minute, 30-minute, and hourly charts are all lit up bullish. The 14-day relative strength index sits at 66.85, strong momentum without tipping into overbought territory. The MACD has crossed positive to 0.019, a confirmed buy signal, and the average true range sits at 0.0213, confirming genuinely tradable volatility. Look at the moving average stack, and price is respecting every support floor. The 10-day moving average at 39 cents, the 20-day at 36 cents, the 50-day at 35 cents, and the 100-day at 37 cents. Right now, price is pressing directly against the big one, the 200-day moving average sitting at 41.9 cents. So, bringing all of that together, how do you actually approach this stock? It really depends on who you are. If you're a macro investor looking to park capital for the next 5 years, DVLT is, bluntly, uninvestable right now. Your job is capital preservation, full stop, and staying away from fundamentally distressed equity. Before this stock deserves a single long-term dollar, 3 things have to happen. A replacement auditor needs to verify roughly $750 million in disclosed contracts. The Pomerantz fraud investigation needs to be resolved, and the company needs to officially cure that NASDAQ $1 bid deficiency before August 24th. But if you're a tactical trader here purely for the momentum, this becomes a highly speculative, short-term opportunity built around forced algorithmic buying and margin calls. Your entry condition is simple: a confirmed break above that 200-day moving average at 0.419, paired with strict respect for the support floors underneath it. For the traders sticking around for that setup, here's the actual blueprint for early July. Do not chase intraday exhaustion spikes. Instead, wait for a pullback into the classic pivot near 40.2 cents, or the Fibonacci S1 support zone between 39.4 and 39.6 cents. Your real confirmation that the squeeze is back on is a daily close above the 200-day moving average at 41.9 cents. From there, scale profits at clearly defined resistance levels of 40.9, 41.7, and 42.4 cents. If momentum truly ignites again, the next real test is that recent 44.30 cent high, followed by an algorithmic projection target near 50 cents. And remember that NASDAQ deadline hanging over this whole story? The theoretical, mandated cure target sits at a full $1. Could this actually get there before August? It's a real possibility, but far from guaranteed, and treating it as anything more than a low-probability stretch target is how disciplined traders turn into long-term bag holders, which is exactly why risk management matters more here than almost any other trade you'll take this year. Protect yourself with dynamic trailing stops set at the 10-day or 50-day moving average, and keep a hard stop loss just below the S2 support level at 38.7 cents, no exceptions. So what does all of this actually add up to when you weigh the extreme risk against the extreme reward? Datavault AI is a genuinely rare divergence between a company in real financial distress and a market structure that's mechanically primed to explode higher in short bursts. By understanding the elevated short interest, the punishing borrow fees, and these key moving average crossovers, disciplined traders have a real window to capitalize on forced algorithmic buying. But make no mistake about the prime directive here. Capital preservation comes first always. This is a distressed, high-volatility name, and if price breaks below your defined support floors, that means the mechanical setup has failed, plain and simple. When that happens, you exit, you take the small loss, and you live to trade the next setup instead of becoming a long-term bag holder in a company that hasn't even had its books verified. Before you go, a quick but important disclaimer. This video is for informational and educational purposes only, and nothing in it constitutes financial, investment, legal, or tax advice. Datavault AI is a genuinely volatile, high-risk security tied to an ongoing fraud investigation, an auditor resignation, and a looming NASDAQ delisting deadline, and there is a real possibility of significant or total loss of capital. I am not a licensed financial advisor, and everything discussed here reflects publicly available information and personal analysis, not a recommendation to buy or sell any security. Always do your own independent research and speak with a qualified financial professional before making any investment decision. Now, I want to hear from you. If you were holding DVLT going into that NASDAQ deadline in August, at what price would you personally decide the mechanical thesis has failed and it's time to walk away? Drop your number in the comments. I read every single one, and I genuinely want to know how you'd play it. If this breakdown helped you see this stock more clearly, do me a favor and smash that like button. It genuinely helps this channel reach more traders who need to see this. If you're new here, hit subscribe and turn on notifications, because we track setups like this one in real time, and you do not want to miss the next call. If you got real value out of this analysis and want to support the channel directly, you can send a super thanks right here on YouTube. It means more than you know and directly fuels more research like this. And if you're serious about leveling up your trading and investing, come join our channel membership. It's built specifically for traders who want deeper dives, faster alerts, and a genuine community pushing each other to make smarter, more disciplined decisions. This is Smart Stock Sam. Trade smart, protect your capital first, and I will see you in the next one.